We are diving straight into an analysis report titled RRX Phase 2 Success. Is this the turning point?
This piece covers Recursion's positive Tupelo trial data and what it means for their AI platform. Let's jump right in.
Okay, first off, the scientific anchor of this piece is fantastic. You absolutely nailed it.
Oh, completely. The detail on the durability data.
Yes, that 53% median reduction. Even after the 12-week washout period. That is so clearly the bedrock of the whole turning point idea.
It's an incredible result, which brings us to our first point. The analysis report must more aggressively integrate this wow factor durability data to counteract the muted market reaction and really justify that turning point thesis.
I agree. The weakness here, I think, is structural. The report does a great job identifying this huge finding. 82% of patients keeping a reduction, the median deepening to 53%.
It's massive.
It is. But then the analysis sort of treats the scientific win separately from the market analysis in Section 3, the sell the news section.
And that creates this disconnect, a narrative gap.
Exactly. So the argument for a turning point feels scientifically sound, but financially unproven. At least within the structure of the report itself.
Right. The market barely moved on the news. Just a tiny bump. And that tells you investors are still skeptical. They're looking at this through the old lens of, platform biology risk.
So the suggestion here is to use that science as a hammer.
You have to immediately leverage the unique profile of REC4881, especially that post-washout efficacy, as just irrefutable proof.
Proof that the Recursion OS found a genuinely novel interaction.
A novel mechanism, MEK inhibition in FAP. And you use that fact to reframe the market's skepticism. It's not a valid long-term concern, you argue. It's a near-term mispricing event. It's just short-sightedness.
I like that. Leveraging the science to get narrative leverage over the finance. But how do you actually do that in the report? Structurally. I'm worried just adding a strong paragraph won't fix that split we talked about.
No, it needs more than that. It needs a hard revision. I'd suggest reordering Section 3 and 4. Or, maybe even better, weave them together.
So for example, when you mention the market's weak reaction.
You immediately pivot back. You hit them with the durability data and say, and this is why the market is demonstrably wrong right now.
I see. So you present the skepticism, then immediately counter it with the scientific antidote before the reader can even settle into that negative conclusion.
Precisely. And to be really concrete, you need to frame that durability finding as more than just efficacy for FAP.
Right, it's not just about this one disease.
It's a critical de-risking feature. It validates the predictive power of the entire AI map, the whole Recursion OS. The report has to argue explicitly that the market is valuing this based on the small FAP market alone.
When it should be valuing the now validated platform that underpins the company's entire future.
That's the story.
And that specific point about the deepening response after the washout period. It doesn't just last, it gets better.
It actually improves, yes.
That says so much about the drug fundamentally resetting a biological pathway, which is, the whole promise of the AI discovery engine in the first place.
That detail has to be front and center.
Absolutely.
And that scientific finding needs to be right at the top of the investment conclusion. Think about this. You could open the conclusion for investors by directly challenging that tiny plus 2.34% stock gain.
Hold it right up against the 53% reduction durability.
Exactly. You force the reader to see that gap between the science and the current valuation. Make it impossible to ignore.
That's a powerful way to frame it. And that challenge to the market really brings us to the scope of the report. The skepticism that's out there is so focused on the total addressable market for FAC.
It's a classic case of missing the forest for the trees. So while the report establishes platform validation, it really needs to broaden its focus by explicitly quantifying how this REC4881 success de-risks the entire pipeline and those huge partnerships.
Okay, so the weakness here is that the analysis correctly identifies the small FAPTEM as the reason investors are hesitant.
Right. And it mentions de-risking the other assets, REC994, REC3964, and of course the big Roche Genentech deals.
But it doesn't give those points enough weight. They feel like an afterthought. So the discussion about the FAT market it overshadows the much, much larger value that's been unlocked by proving the platform works.
Let's just pause and clarify something for a moment. When we say validating the Recursion OS with this trial, what does that success actually confirm? What's the core takeaway?
It's confirming that the AI model can find a novel therapeutic target, in this case, MEK inhibition for FAP, that then proves to be durable and effective in actual human beings.
Right. That jump from a computer model to real human durability, that's the whole proof of concept.
And it suggests that all the other predicted targets in their pipeline now have a drastically lower chance of failure. They're just inherently more valuable today than they were before this data dropped.
And that reduced failure rate is the key. That's the piece of information that has to be translated into a financial argument, one that's big enough to overcome the small TAM issue.
The report mentions the company's cash position. It's substantial. What is it? $427 million?
427.6, and a runway into 2027.
So how do we make those facts really drive home the de-risking thesis?
Well, the suggestion is to stop talking about that runway as just time. We need to start framing it as productive, validated time. The report should use that cash position and the runway to calculate or at least frame the new value that's been created by this platform validation.
So you shift the focus away from FAP's revenue potential and onto the improved efficiency and reduced risk of the whole R&D operation.
That's it. So instead of just saying they have cash to last until 2027, the argument becomes they now have 4 years of R&D where the probability of success for every single asset has demonstrably improved.
Meaning that cash buys exponentially more R&D value now. The cash itself has become a more productive asset because of this trial.
Exactly. In Section 4, you have to address the skepticism head-on. State that the FOP-TAM is largely irrelevant compared to the validation of the OS, which is the engine behind that massive Roche-Genentech collaboration.
Which is a multi-billion-dollar opportunity.
And Tupelo validates the engine powering it. That is the bigger narrative here. That's the turning point.
To really give the analysis some teeth, though, it feels like we need a concrete comparison, something to show the efficiency gains from the AI.
I agree. You have to pull the curtain back for the reader. Show them the difference between the old way and the AI-driven way. I'd propose adding a short comparison. Look at the historical clinical success rates for MEK inhibitors found through traditional methods.
And put that right next to the success we're seeing here.
Yes. Use that comparison to reinforce the de-risked status of assets like REC 994 or REC 3964. The success in this one trial fundamentally changes the risk calculation across the entire portfolio.
Okay, that makes sense. Now let's move to the trickiest part, valuation. The argument in the report is that the current $2 billion enterprise value needs a much better justification, one tied directly to these Tupelo results.
Which leads to our third point. The report should introduce a more sophisticated metric for valuing the AI platform itself, moving beyond a simple enterprise value calculation.
The weakness here is pretty clear. Section 5 says the EV is about $2 billion. But then, it doesn't give any unique analysis for why the Tupelo data specifically justifies or elevates that number.
It just reads like a standard financial fact sheet. It's missing that proprietary insight that a turning point analysis promises.
This is where the report needs to get a little creative. The core thesis is that the AI has been validated, so the report should try to quantify that newly confirmed predictive premium that's embedded in the $2 billion EV.
The suggestion, then, is to create a framework, a new way of valuing the reduced clinical risk that comes from the Tupelo trial. We have to move beyond standard comps.
Hold on, though. Isn't trying to quantify a predictive premium kind of speculative? Your typical institutional investor wants hard numbers, discounted cash flow models. We have to balance a creative idea with financial reality.
That's a fair point, and the skepticism is warranted. The report has to address that directly. But the way you bridge that gap is by showing how Tupelo fundamentally changes the inputs for those traditional valuation models.
I see. So you're not throwing out the old models.
Not at all. You're improving them. If Tupelo's success means every subsequent candidate now has a higher probability of success, a higher POS, in phase 2, well, that has immediate, quantifiable financial implications for the whole pipeline.
That's the proprietary insight. That's what we need to establish.
So what are the most creative, but still actionable, ways to quantify that shift in POS?
I think you start with the biggest number on the table. Frame the $2 billion EV relative to the potential milestones from the Roche-Genentech deal.
And use the Tupelo success as a multiplier.
A proven multiplier for the probability of actually getting those future milestone payments. That directly connects the AI's performance to future very large revenue streams.
And that gives the current analysts' price targets more context, which they desperately need. Instead of just saying the consensus is around $8, you analyze how the Tupelo durability data specifically should influence key inputs in those analyst models.
Things like the discount rate or the probability of success for future programs?
Exactly. You show the recipient of the report exactly how their own valuation model should change now.
That's powerful. You're not just critiquing the market, you're actively guiding the reader on how to revalue the company. And to really make the analysis stand out?
I think you challenge the report to introduce a new internal metric, something like validated pipeline asset value per drug candidate.
A creative, proprietary measure for the platform's worth now that it has human proof of concept?
Right. It moves you past the generic number of candidates in the pipeline metric. That would give this analysis a truly unique edge in a very crowded space.
This is a really robust framework. These revisions are going to maximize the impact of this analysis report. We've definitely covered some significant ground here.
Look, the foundation of the submitted report is excellent. These high-level suggestions are designed to push that turning point thesis from just compelling science into an undeniable financial argument.